Good afternoon, and welcome to VNH Planned Giving webinar, Leave a Lasting Legacy. My name is Sharon Giguere, and I am the Manager of Community Relations and Marketing for Visiting Nurse and Hospice for Vermont and New Hampshire. Today we have Tim Caldwell. He is a counselor at law at Caldwell Law, Estate Planning and Settlement. Timothy has over 26 years experience in the Upper Valley, and since 1997 has concentrated his practice on estate planning and settlement. He graduated cum laude from Dartmouth College and earned his Juris Doctorate from Georgetown University Law Center. He served as chair and member of the Lyme School Board, the New England Nordic Ski Association, the Upper Valley Planned Giving Council, and was instrumental in establishing Leave a Legacy NH Vermont. Tim is also a Respecting Choices Advanced Care Planning Certified Facilitator. Currently, he serves as a regional advisor to the New Hampshire Charitable Foundation and is a coach for the Ford Sayre cross-country ski team. Prior to practicing law, Tim was a competitive cross-country skier. He competed in 4 Olympics and 3 World Championships. He and his wife, Margaret, a longtime social studies teacher at Hanover High School, have lived in Lyme Center, New Hampshire since 1989. Margaret and Tim have 3 children, Lucy, who lives in London and works for Deloitte, Heidi, who is a graduate student at the University of Vermont, and Patrick, who is a senior at Dartmouth College. The family enjoys a variety of activities, including skiing, hiking, swimming, and spending time with friends and relatives. Tim, thank you so much for joining us today.
Okay, well, thank you, Sharon. Thanks for having me, and welcome, everyone. Be nice to see you, but I'm hoping you're there listening to some of this. So we're going to spend a few minutes today talking about planned giving. And actually, I'm going to start with charitable giving during lifetime. And so when we talk about planned giving, that means it's a gift that I'm making at death. We'll start with the charitable giving that we make, gifts that we make during lifetime. And many of us make charitable gifts during our lifetimes, whether it's to a school, a medical facility, an art museum. The Haven is a very popular charity in this area to make gifts to. But most of us are in the habit of making some nice, they're relatively modest gifts to charities during our lifetime. Maybe every week I give something to my church, for instance. One of the things, there are a variety of assets that we can give to charities. The most common is cash, and that's pretty simple. In the old days, before the tax law changed, it was pretty easy for people to get a charitable deduction for those gifts. And that may or may not be important. But when I make a gift to a charity, the law says if I've made enough gifts, or if my other deductions against my income tax are sufficient, I can deduct the amount I gave to the charity. So for some people, that's important. It could save 20 cents on the dollar, 30 cents on the dollar. Who knows? It really depends on your income tax bracket. So the most common gifts, as I said, are gifts of cash. If you are over 70 and a half, and if you have a retirement account, you can ask the custodian of the retirement account to make the gift directly to the charity. And that's a very tax efficient way to use retirement account assets. Remember, retirement account assets, you are paying income tax when you take the money out. That's the law. And if you die owning the retirement account and it goes to your kids, let's say, or your spouse, when they take money out, it also is subject to income tax. Whereas if I give some part of that retirement account to a charity, they get the whole 9 yards. They get the dollar and they don't have to pay any income tax. So that's a very efficient way to make gifts during life. And as we'll talk, it's also a very efficient way to make charitable gifts at death. So,
Tim?
Yes.
Just one quick question. So the person who is making the gift from the retirement account to the charity, they wouldn't be paying income tax on that because they'd be making the gift to the charity? Or they would income tax?
So that's a great question. So remember now, I'm not going to recommend, we don't recommend making gifts from my retirement account to charity unless I'm 70 and a half. Okay. So now I'm 70 and a half, and I'm going to direct. So I'm going to direct my custodian to send $500 to the VNH. Okay. It's going directly from the custodian of the account to the charity. So zero tax. I don't pay any tax. Some financial institutions will actually give their account owners a checkbook, and they can write $25 checks, $250 checks, whatever, directly to the charity. And we have a number of clients that have the checkbook from whatever financial institution is holding their retirement account, and they're writing checks directly to charity. And so it's a lovely way to do it. It's very easy, and there's no income tax. And those distributions that you make to the charity count as part of your required minimum distributions that you have to start when you're 72. The law just changed. It used to be the year following the year you turn 70 and a half. Now it's when you're 72, you have to start taking those required distributions. And it's a big number, but we can give away up to $100,000 from our retirement account every year to charity. And each of those gifts will count towards our minimum required distributions. So the sort of the ingredients for this type of plan, or no, it's not planned giving, charitable giving, excuse me, are the following: charitable intent, always have to have charitable intent, and a retirement account, and you're over 70 and a half. Those are the three key ingredients. And then don't make gifts over $100,000. Now, most of us don't make gifts that large, but as any charity will tell you, all gifts are appreciated. And
this is true.
this is true. And so it's, again, going back to the lifetime giving, we often are in the habit of making gifts during our lifetime. And they may be $25 gifts, they may be $50, maybe they're $200 gifts. Those gifts add up, and they're really, really important as typically part of the annual appeal for the charities. And they're a really, really important piece to sort of charitable giving, but that's the lifetime. So those are the assets that we typically use. We use cash. If I'm over 70 and a half and I have a retirement account, then I'm going to use my retirement account assets. Other assets to consider are, gifting during life, are assets that are highly appreciated. And so a highly appreciated asset is one that you bought for $10 and now it's worth $100. So the value has gone up a lot. And so if you give that asset to a charity, they get the $100, they sell it, and they don't pay any income tax. Whereas if you sold that thing, whatever it was, that's worth $100 now, you'd be paid what's called capital gains tax on the difference between the purchase price, $10, and the current value, which is $100. So that highly appreciated assets are also a very favorable asset to give to charity. Another type of asset that you might want to consider actually is your house. If you don't have beneficiaries that you want to give your house to, you can make a deed, sign a deed that will convey what's called the remainder interest in your house to the charity. And so I'm saying, so Tim conveying to his favorite charity what's called the remainder interest in the real estate. What I reserve is the right to live there the rest of my life. All right. And so it's an asset. It's probably a pretty big asset, but let's pretend no one in my family wants it, or I don't have beneficiaries who would normally take the house. I don't have any kids, let's say, or whatever. So that type of of asset is a pretty good gift. And now I live in the house the rest of my lifetime. I die, the charity gets the house, and they sell it, and they whatever, they sell it for $200,000, $300,000, and they have it's a lovely gift for the charity. You'd have to be a little careful because it's a big gift, and we'd have to, if I was going to apply for Medicaid, I would not have wanted to make that gift within 5 years of applying for Medicaid. So we got to be a little careful with gifting and Medicaid, Medicaid can sneak up on us. There's that 5-year rule. So we just have to be careful there. So those are really lifetime gifts, a quick overview of some of the lifetime gifting strategies that people engage in. And as I said at the beginning, most of us make these gifts. I think it's 70 or 80% of the population make charitable gifts during their lifetime. What we find when people die, they often have forgotten their charity. And I'm not 100% sure why that is, and I'm not sure. I'm sure there's not just one answer for that. But it may be that, well, I don't have much money, and the charity's it's not gonna make much difference to the charity. Well, my $50 gift that I made during my lifetime, the charity was happy to receive that. Well, one way to say, why won't they be happy with a $50 gift at death? Or I could think about, well, let's see, what's $50? That's $50 a year. How much do I have to give to this charity to essentially continue that $50 gift in perpetuity? So one way to think about that, okay, like a common number there is $2,000. So if I give the charity $2,000, the $2,000 is going to earn roughly 5% a year. Let's just pretend, easy math for me. Well, I've given them $2,000. That $50 a year is going to continue to be made to the charity, even though I'm long gone. So that's something to think about. And a $2,000 gift, at my death, that's a pretty modest gift. My kids or my spouse won't miss the $2,000. So that's an example of a planned gift. Now, how do I make planned gifts? Well, there are a number of ways to make planned gifts. What we hear most about probably, and probably the most common, is through my will or through my trust. And so a will is a writing that says, this is what I want to have happen to my stuff, all my assets, when I die. A trust is going to do the same thing. So my will could say, I want to make a specific bequest, it's called the bequest, to my favorite charities, all right? And then I want everything else to go to my spouse, let's say, or everything else to go to my kids. And so it's simple enough to add language for a charitable gift in a will or in a trust. And those are the most common types of planned gifts, adding the charity to the will or the trust. Sometimes the gift to the charity is what's called a specific bequest. I'm giving $5,000 to my favorite charity. Sometimes it's a remainder gift. I'm going to give, let's say, specific gifts to ABC people, and then the charity gets what's called the remainder of my estate. And when I talk about wills, the same applies for trusts. The same provisions can apply for a trust. So those are the most common, that's the most common type of planned gift. Again, it takes effect. The gift is made when I die, okay? Another example of a planned gift is when I name a charity as the beneficiary of an asset that I own. Now, remember a few minutes ago, we were talking about retirement plans and retirement accounts that once I'm 70 and a half, I can make gifts of that account to the charity during my lifetime. Now I'm dying, who are the beneficiaries of my retirement account? Well, that's a little bit of a question. I'll give an example for me. My charities are, my beneficiaries, excuse me, are I have 5% going to my favorite charities, and then the balance to my wife. And so I expect to die before my wife. And so I want to assure there's a gift to the charity, but I don't want it so big that it might impact my wife's lifestyle after I'm gone. So 5%, it's a number she really won't miss, 5% of my retirement account. But it's a number that makes me comfortable, makes me happy that I'm supporting these charities. So that's when I'm living. I'm sorry, that's when I have a spouse. Okay, so if I die first, 5% to charity, the balance to my wife. Now, I've used the retirement account because of the retirement account. I'm going to sort of lose my train of thought here a little bit, but the rules on retirement accounts changed this year, at the beginning of this year. And when the beneficiary of a retirement account is a non-spouse, the money has to come out much more quickly. And so going back to my wife as the primary beneficiary, she gets 95%, charities get 5%. Let's pretend now that I've survived my wife, okay? And I'm single. And I have my wife and I, as Sharon said, we have 3 children. And so I have my retirement account. I'm single and I have 3 children. And other than the retirement account, I have some other assets. Maybe I have a house and maybe I have some money in the bank. And I'm still charitably inclined. I look at those assets, the house, the bank account, the retirement account. I'm going to say, okay, the retirement account, and let's say they're all on paper the same value. They're all worth $300,000. Let's just pretend. Okay. So I have 3 types of assets: real estate, bank account, retirement account. Each of those accounts is worth $300,000. And I want to give something to charity and I want to give something to the kids. So what I'm going to do is I'm going to say, okay, how much do I want to give to charity? And let's say $50,000. I'm making up these numbers. Which bucket am I going to take it from? Well, I'm definitely going to take it from the retirement account bucket. And the reason I'm doing this is, A, it's not going to impact me during my life. The charity is just the beneficiary when I die. Okay, so I still have all this access to the retirement account. When I die and the charity gets this $50,000, they get $50,000. They don't have to pay any tax on it. Whereas my kids, if they got that $50,000 retirement account, A, they have to pay tax on it and they have to withdraw it within 10 years of my death. And my kids are all much smarter than I am and will earn much more money than I am. And so they'll be in a high income tax bracket. And they're getting this retirement account from dad. They're paying 30 or 40% of what the account is worth. So they get $1, they're paying 30 cents on each dollar that they receive in income taxes. And if they live in a high income tax state, like the great state of Vermont, well, then they're going to pay even more. And so it's really a no-brainer when it comes to what asset I want to give to the charity when I'm thinking about a planned gift. I'm virtually always going to take the retirement account asset and peel off a part of it or give the whole thing to the charity, because it really is worth less than the other assets to my family. It's worth just the same to the charity. So it's a very good asset to give to charities, and it's been made more so recently by the law change. In the old days, last year, the kids could take the retirement account over their lifetime. Now they got to take it in 10 years. So that's a beneficiary designation that we can use for retirement accounts. Another asset controlled by beneficiary designations are life insurance policies. And so I may name my charity as a beneficiary of my life insurance policy. And again, please understand, it doesn't have to be the whole 9 yards. The charity could be a beneficiary of 10% of my life insurance policy, or 100% or 5%, whatever. It doesn't matter. It's what I want to do in terms of supporting my favorite charities. So,
Tim,
yes.
Is there any tax on that to your spouse or children on the life insurance if that is left to them?
Okay, yeah, great question. So life insurance is income tax free. And for most of us, so I have a life insurance policy. Let's say it goes, unless anything I give to my wife will not be taxed. Death, gifts to spouses are not taxed, okay, from an estate tax perspective, okay? Let's say I'm single and my life insurance policy goes to my kids. And so it's a great question, Sharon. Will that be taxed? And the answer in my case is an unequivocal no, because my estate isn't big enough to be subject to the estate tax. So for most of us, the life insurance that we leave our kids, non-spouses, will not be taxed because our estates are less than, in Vermont, it's going to be next year, it'll be $5 million. Right now it's $4.25 million in Vermont. The federal estate tax is $11.5 million as federal exemption. So it's a huge number. And most of us have estates that are less than $11.5 million. Now, that law is set to change at the end of 2025. Who knows what's going to happen in the upcoming election? That may impact what that exemption is. It may go back to $5 million, sooner than we think. But right now, again, for most of us, that life insurance will not be taxed. Now, if I have a really big estate, let's say I have a $20 million estate, and I don't, but let's pretend I did, and I'm single, and $5 million of that is a life insurance policy, I could name the charity as the beneficiary, and that would be treated as a deduction. So it's out of my estate. And so that $5 million would not be subject to taxes. Then it'd be just the difference, whatever, $15 million, I have to apply my exemption, 11.5. So that's $3.5 million would be subject to the estate tax in that case. So that's how that works. So the planned gifts, again, wills and trusts are common ways to do it, to make a planned gift, excuse me. And the beneficiary designation is also especially when I have a retirement account. I'm a little broken record on the retirement account, but the retirement accounts have gotten worth less, worth less to transfer to non-spouse beneficiaries. And so they are a prime asset to use not only during life, once you're 70.5, but also at death if you want to make charitable gifts. Now, please understand, we make the charitable gifts because we really support the charity. Getting an income tax benefit is nice, but it's not why we make the gift. And actually, speaking of that, this year, there is a special rule. I think it came from the CARES Act with all those, the new rules coming down, given COVID. Each one of us gets to make a charitable gift this year up to $300, and we can deduct it from our income taxes. And so that's a one-time deal. Usually we have to have deductions over, if we're single, over around $13,000, and if we're married, over $24,000. But this year we can make a gift of up to $300 to our favorite charity, and that's going to be a deduction against our income taxes. And so, it may save us whatever, from $10 to $70 or something like that. So I may make a gift, and let's say I'm at a higher bracket. Well, I make a $300 gift, but it's actually only costing me $230, let's say. So that's a one year only, and it's limited to $300. But it's a nice incentive to make charitable gift.
Yes.
So I guess I think we're getting close to the end of our time, but I really think it's important to, when we're thinking about our estate planning, is look at the people and things that are important to us, and who have we supported, let's say, when we're thinking of charities during our lifetime, and then figure out a way, how can we include them in our estate plan? And that's called a planned gift. And that would be, again, either through beneficiary designations or through a will or a trust. And I don't think we should worry about the size of the gift. I think making the gift is the important thing. And the charities, believe me, Sharon can speak more to this than I can, but when we were working with the New Hampshire, Vermont Planned Giving Council, it's clear. It's a huge deal for charities to receive consistent planned gifts. Really, really helpful. And it's easy to do, and it doesn't have to have we can take care of charities and our family at the same time.
Yes, thank you. One question. So how would someone designate a donor advised fund to a charity? Is that the same as retirement, or?
Yeah, okay, so great. A donor advised fund typically is a fund that a person sets up during lifetime. And so they put money in this fund, and then they get to advise. Typically, it's going to be a community foundation, say the Vermont Community Foundation or the New Hampshire Community Foundation will be the holders of the fund. And then the donor will say, I want to make gifts this year to XYZ charities. And then the institution, the community foundation, makes the distribution. And I can put assets in that during my lifetime, of course. Certainly I put assets in it. What I can't put in the donor advised fund during my lifetime is my retirement account. Even though I'm 70 and a half, I cannot take money, as we were talking earlier at the beginning, I can't take money from the IRA and contribute it to the donor advised fund. That doesn't work, okay? I can name the donor advised fund as a beneficiary of my retirement account at my death. So it's a little confusing there. And so if I have a donor advised fund, it's essentially a charity, the donor advised fund. It's held by a charity. Financial institutions have donor advised funds as well. I mean, some, all the big, name sort of money houses, if you will, have these donor advised funds that you can put money into and then direct distributions from those funds. One of the nice things about the community foundations that we have in our area, they know a lot about the charities on the ground. And so they do a lot of research and can give good advice about what charities are doing great work and things like that. So can give advice to the donors.
Okay.
Is that helpful?
Yes, that is helpful.
Okay, great.
When should one start thinking about planned giving?
Oh, mercy. You're asking an estate planner. And what's the answer? Well, you can certainly. I think, and that's a little bit of a flip answer, certainly, but we encourage when our clients come to see us about their estate planning, we ask about their charities that they support and how might they want to include them in their estate plan. And so it's planned giving and estate planning are connected, and you want them to be coordinated. And so, I think in our experience, people start thinking about charitable planning seriously, planned giving for seriously, probably around retirement, death of a spouse, death of a parent. Maybe they've had a sometimes people call it maybe a mortality moment. Maybe they had a bout with some disease and they got great care from one of our medical institutions. Maybe some charity really supported a parent and they want to make sure that that charity is remembered in their plan. And they really saw the work that the charities that they may not have had much experience with in the past, but seen the work they do and they want to support that. So when we should do it, well, again, while we can, the typical triggers are what I just said, sort of, retirement. So my wife and I, when we had our first estate plan, if you will, it was when our first kid was born. And we weren't thinking about charities. We barely had 2 cents to rub together, but we were thinking about what happens if we're both dead before the kid is, 18 or 25. And so that was our first plan, but we weren't ready to think about charities. At least we weren't. We just, we didn't have any money at that time. Once I retire and I'm sort of comfortable with, I hope I'm comfortable with the resources I have, that's probably more likely time to start thinking about charity. And and single people. There used to be a joke for Dartmouth guys. Dartmouth guys tended to marry women from Smith College. And the joke was that the director of planned giving at Smith loved all the Dartmouth guys who married her college's graduates, because they would die, leave all the money to their wife, and then the wife would leave money to Smith. So, so oftentimes the planned giving, the point of that little silly story is that oftentimes the planned gift really comes at the survivor's death, if it was a husband and wife. Okay. But we encourage you to think of those charities that you've supported during lifetime and then try to figure out a way to incorporate them into your estate plan, and that becomes a planned gift.
Well, Tim, thank you so much for taking the time today to talk about planned giving. We really appreciate it, and I hope you have a great day.
Okay, well, thanks, Sharon. Take care. Take care, everyone. Okay, bye-bye.